Good morning, everyone, and welcome to another episode of the Creative Bird Strategies podcast. I'm your co-host and co-founder, Joe Scarice, alongside with my partner and co-host, Yardell Perkins. We're excited to have you here for another great conversation focused on real estate investing, creative finance, and building wealth through smart strategies. As always, the Creative Bird Strategies podcast brings together investors, entrepreneurs, and industry professionals for networking, education, and actionable real estate investing strategies. We meet the first and third Sunday at 9 a.m. We meet with and catch up on all types of episodes as well and resources at the creativebirdstrategies.com website. So really excited about this morning. We have a great conversation coming in here today. Today's episode is one you don't want to miss. We're pulling back the curtain on what investors consider the secret sauce behind asset-based lending underwriting, whether you're an experienced investor, scaling portfolio, or just getting started with the creative financing. Understanding how lenders evaluate deals can give you a significant advantage. To help us take a deep dive, I'm hopefully having a colleague of mine, Valia Fisher, Vice President of Loan Processing and Head of Transaction Coordination at Built Lending. She's extensive experience in loan underwriting, transaction management, and helping investors successfully navigate the lending process. She's going to share some valuable insights, what lenders are really looking for, common mistakes investors make, and how can you position deals for approvals, for success. But before we jump into today's main discussion, let's take a few minutes. I always cover a little latest news and developments impacting real estate market. So grab a cup of coffee, get your notepad, and let's get started with today's real estate news. So first, I want to make sure I invite everybody in to our room in Clubhouse, because we're also live on Clubhouse as well. And then I'm going to see if our colleagues are down below in the audience. Just give me just a couple minutes. A lot of people online today. Okay, all right. Let's get started here. All right, let's see if I can find Valia down below. She is not here just yet, but I will make sure she's I don't know where she's at, but that's okay. We'll get started here in just a few minutes. If worst case scenario, Yardell will be asking me the questions as well. So we'll see if she comes in. She is on West Coast or mountain time, so we'll see if she comes in at all. Let's see. We'll try that out. So a little update to the real estate news segment, everyone. Before we go into this discussion on the secret sauce behind asset-based lending, a little update to the market. Mortgage rates remain biggest story right now. Federal Reserve recently held interest rates steady, but signaled that inflation remains a concern, that additional rate increases are still possible later this year. As a result, mortgage rates continue to hover, in the mid 6% range, with the average 30-year fixed mortgage sitting around 6.5. They might come in a little lighter. Actually, I'm seeing the rates low sixes, high fives, depending on LTV, DSCR, and credit. Housing inventory is finally improving. One of the most encouraging trends we're seeing is a gradual increase in housing inventory across many markets. More listings are hitting the market, and buyers are gaining slightly more negotiating power than they've had in years. Some regions are even seeing more sellers than buyers for the first time since the pandemic boom. For investors, this means more opportunities to find motivated sellers, less competition on certain deals, better chances to negotiate price reductions, and seller recessions. Demand is surprisingly resilient still. Despite higher interest rates, housing demand continues to hold better than many economists are expecting. Pending home sales and mortgage purchase applications are running ahead of last year's pace, showing that buyers are adapting to the current rate environment. This is important because it tells us that the real estate remains fundamentally driven by long-term housing demand. People still need places to live, and investors who can solve housing problems continue to find opportunities. Affordability remains a major challenge. According to recent housing research, the income required to purchase a median-priced home has nearly doubled since 1920. Median home prices remain above $400,000 nationally, while mortgage payments have increased dramatically over the past several years. This affordability crisis is creating opportunities for investors in affordable housing, workforce housing, midterm rentals, shared housing models, creative financing solutions. When traditional homeownership becomes harder, investors who can offer flexible solutions often benefit. And then regional markets are moving in different directions. We're no longer seeing a single national housing market. Instead, we're seeing highly localized opportunities Some Northeastern markets continue to struggle with low inventory and strong demand, while markets like Austin, Houston, San Antonio, and Phoenix, parts of Florida are seeing increased inventory and more buyer leverage. That's why local market knowledge is more important than ever. National headlines matter, but successful investors focus on the numbers and opportunities in their own backyard. What does this mean for the creative investors? If there's one takeaway from today's market, it's this. The investors who understand financing are gaining major advantage as traditional lending becomes more challenging and rates remain elevated. Knowing how lenders think, how underwriting works, and how to structure deals creatively can be the difference between getting a deal funded or losing it altogether. And that's exactly why we're excited to have today's guest joining us. Hopefully she'll be coming in. I don't see her just yet. Hold on one second. I see another moderator up here. We got to get her up there. Yeah, but and again, I've worked with Valia. She's spent years behind the scenes in underwriting, loan processing, transaction coordinating. I think this will tie in. I mean, if she doesn't come on, I'll definitely be able to carry the water on this with some of the questions. I already gave them to Yardell to be able to provide some of these questions as well. So yeah, I mean, listen, we try to get her on, but it didn't work out perfectly. Nothing ever does. I'm just going to do a quick invite to some people in in Clubhouse, see if anybody else is sitting around there that we have not invited in before we get into this deep discussion right now in the market. I'm just making sure we got everybody invited first. Not a lot of people online this morning, so that's okay. Sorry, we got the right people here. That's all that matters. So, Yardell, good morning and welcome. My co-founder, co-host of the podcast. Give a little brief intro, a little update to what we're doing. Where we're live right now, where no other Clubhouse group has this capability at this point. Yardell Perkins of Perkatech. I do. We doing right now, social media wise, for the podcast, where people to have accessibilities to the content following post production? I don't want it to look unnatural, so that's why we hired a consultant to help us develop the AI video correctly. I've done close to 300 videos on BombBomb, but we're just trying something a little different to add to our repertoire and to our websites as well. What I'm excited about also, I sat down with another consultant, Yardell is going to be working with me. We're going to package the underwriting white label course and overview for real estate offices and real estate agents across the country. We just sat down with a national publication group that does PR, and she's going to help us bottle it and get it out online where we can offer that service for real estate offices and agents and other professionals in the space across the country. We're going to obviously focus East Coast, east of the Mississippi, but as it grows out, I think, of course, we're going to expand upon that with our white label underwriting course. We just had another great class yesterday. A lot of good stuff happened. I think I've taught close to a couple hundred people so far with this new white label course, and I think it's making impact. It's giving a lot of good content for people to understand what asset-based lending and direct private lending really does for the investor and allows them to scale and grow. And I think the part of the social media piece as well scares a lot of people. Like I just sent an email out to the students yesterday, looping in Yardell, and a lot of people just don't know where they need to position themselves social media wise. And that's another piece of the secret sauce, because you need to be found if you're putting out good content. And if you're not in the right places and connected correctly, you're like a billboard in the desert. And I think Yardell, would you like to add something to that before we get into some of the questions? I think Valia just came in. I just invited her up. Hopefully she'll accept my invite to come up as a guest. So I just did a quick invite to get her up here. So hopefully it'll take a minute for her to figure it out logistically. I just sent her an invite. Let's see if she comes up again. Hold on 1 second. Let's go. Uh, um, she's coming. There she is. Valia. Valia. Good morning. How are you? Fantastic. Listen, I want everybody to know Valia Fisher is the secret sauce behind the volume of business that Joe Scarice is doing. I drive her crazy consistently Monday through Friday, sometimes now on weekends. And I really appreciate you coming in here for a few minutes and meeting and greeting everybody in the podcast. Yeah, happy to do it. That's great. I just heard my voice twice because I'm live on LinkedIn as well as Facebook and YouTube. So really great to have you here. I thought this was a necessary discussion to have sooner than later because of the volume of business that's coming in and the inquiries that we're getting and the type of scenarios that we're seeing now they're not the same from last quarter. They're changing, they're evolving. I just would love to kind of get a little background on you and who you are and what you do. And then we'll get into some questions I orchestrated where you can probably give some insight for real estate investors to kind of take in for future endeavors for themselves. For the last, I'd say, 3 years. Yep. But previously, I've been in the lending space for more decades than I want to let you know on this call. But I have done everything in the lending space from originating to processing to underwriting, the back end operations where I learned a ton when you're having to sell loans out on the secondary market and what they want to see, what those capital investors want to see and what they don't want to see, and how tragic it can be when you're holding long-term paper. My
the expertise, I would say, is in putting together a file, making it look in the best light possible to the eventual end underwriter, so that we get an approved loan and hopefully with not too many folks.
Well, I find you to be a very unique head of processing. I feel like you have an underwriting helmet that you wear when you're looking at these files as you're putting them together for underwriting. What are some top things that you're looking at as an underwriter looks at for the first 5 minutes reviewing a loan file? Like, you get a file in, I submit it to you. I think it's pretty healthy looking. What are the top things that you look at initially that an investor should be aware of?
Well, I think there's two things that are equal. Number one is credit. We want to see that somebody has the minimum score required for the program that we need. And if it's on the lower side, I initially want to see the background right away, because in my experience, if somebody has a lower credit score, they may also have some issues on their background, such as unpaid judgments, tax liens, things like that. And then, as equally important, is the property itself. So I will look it up on Google, get on the map, and walk the neighborhood, see what the neighborhood looks like, and make sure that it's collateral that we know will be acceptable.
What is the biggest mistake real estate investors make when submitting a deal for financing?
Not providing the experience in a format that we can use. It seems like we are always chasing down the proper documentation for experience. So if your client has 3 flips under their belt, but they've used a different entity name for each one of them, which is common, we're always chasing down those entity documents to confirm that they are actually tied to that experience. That's the number one thing, that if those things can be gathered up front, it would save a lot of time, and then we can actually vet that borrower for the program that if it is a RTL or a fix and flip, we want to make sure that they meet the experience requirements, and that has a lot to do with their eventual pricing, right, Joe?
Exactly. I mean, I think people just don't want to be honest about things that we ask, and they're not very complicated questions. I mean, it's like, how many flips have you bought and sold in the last 3 years with ownership? How many properties have you done a burst strategy with and completed in the last 3 years? And how many rentals have you bought in the last 3 years? You would not believe what people think is the truth compared to what actually gets vetted and brought back to us. I mean, we've had that immediate experiences with various deals that we have in our pipeline currently.
It's consistent. It's one of the things that we are always chasing, and that's been, since my time in this lending space, it's always the problem. So we try to explain exactly why we are asking for operating agreements on a property that is not tied to the one that they're purchasing or refinancing at the moment. We need to, of course, they're given a rating. So credit is part of it, experience is part of it, your LTV, what you're asking for, is part of it. So that's why we're asking for documents that don't seem to be related to this transaction. We need them anyway. We're not asking if they're profitable. If they held them as a rental, we're not even asking if those properties are profitable. We just want to know that they have done a rehab, and either they kept it or they sold it.
So, how do asset-based lenders evaluate risk differently than a traditional bank?
We are looking the collateral is our number one, what we look at first, as far as, is this going to be a loan that we want to either hold on our books, or would we not lend to this person? So we don't ask for income documents, which is the biggest difference. We're only looking at if it's a DSCR loan, we're looking to see if it cash flows. If it's a rehab loan, then we're looking to see if that budget makes sense or the work that they want to do. So we run several different variations of appraisals to make sure that the property is going to be worth what they say it will after their rehab is done. or if it's a DSCR 30-year loan, there's actually 3 appraisals that end up getting done, standard, traditional, a desktop, and then a secondary review by an in-house appraiser. Collateral is the biggest piece of puzzle, and we are not necessarily looking for words or tax returns or pay stubs if they're employed. We just want to know that the collateral makes sense.
So what can an investor do before applying that dramatically improves their chances of approval?
Say that again, you cut out a little bit.
What can an investor do before applying that dramatically improves their chances of approval?
That would be showing us some liquidity, showing that we're not taking the last dime in your bank account, and having clean entity documents that haven't been adjusted throughout the years or recently, and just providing the documents that we ask for quickly. We can work as quickly as you can. So that seems to be one of the hardest things to chase down prior documents, because ideally you should have it the deal done before ready to go by the time the appraisal comes in, and that doesn't always happen.
So when you see a deal that's borderline, what makes the difference between an approval and a denial?
Experience, or definitely experience, because if you have a proven track record, even if the client is a little bit on the margin as far as credit, or maybe it's a bigger project than they're used to doing, but if they've completed 5 in the last 3 years, that's going to be the most important to get them over there.
And bonus question, because of it's a little self-promotional for us. What is your thought on us offering and extending white label services for aspiring real estate professional referral partners, as well as offices, as well as white labeling brokers? And where do you see that going with us and them over the next 6 months, knowing that we're coordinating that concept very heavily for our clients and for their clients as well? What's your thoughts on white label?
Well, I think that's for to have access to our financing. We will give you kind of our portal access so that you can generate your own term sheets, send out the applications that we need. And, Joe and I will be able to train you for, what questions to ask, what documents are needed. And our team would just, you'd be assigned a team member that you would be able to reach out to at any time with questions and status. And you'll be able to see through our portal the loan moving through. And so you'll be able to have in real time eyes on the file as well, which is, I don't think many lenders will do that, but we want to see you be successful, and there's no reason for us to gatekeep this information, especially if it's.
Barry, these have been some great insights, incredibly valuable, because understanding how underwriters think can give investors a tremendous advantage when structuring and presenting deals. Now we laid some foundation, let's open it up to our moderators and dive even deeper into the secret sauce behind asset-based lending underwriting. So we'll start with ladies first, of course. Melissa, good morning and welcome. Brief overview, who you are, what you do, and your question for Valia Fisher in regards to the secret sauce behind asset-based lending underwriting.
Good morning. I'm Melissa King, founder of Busy Bee Virtual Solutions and Care Bee Virtual Support Services. I am also a state of Michigan notary, licensed referral agent, and certified national guardian here in the States. We bees here support investors, small businesses, fiduciaries, and family caregivers with the management of their operations, finances, documents. I love that. Clients. We're basically the bees who get called when the hive is already buzzing and nobody knows where the honey went. So, Valia, the discussion you've already had, you can obviously see I was just going crazy on the emojis, because it does come down to documentation. If you are interested in getting into asset-based lending, you do need to get your ducks in a row. It's your numbers, it's your credit reports, your credit ratings. We hit on this every time we are on with Joe. Be consistent. Get your documents, your digits in order. You got to organize today, protect tomorrow. That's how you're going to make better decisions, right, Valia?
Yes, I could not agree more. Yes, I could not agree more. We can assist with getting some of those ducks in a row if they're not really quite there yet, but having them done ahead of time is only going to make the process faster and more enjoyable for everybody.
Absolutely. And you brought portal up. I love portals, but there's a lot of back end people who are still doing old school. They deal with paper. So remote people like us can definitely take a PDF and split it. Look, I'm even getting I'm applying for a HELOC right now as a self-employed person. My husband is self-employed. So we're going through all that different non-QM fun stuff right now. But because we have our documentation in order, we're able to speak to the lender with some intelligence about our documents and digits, and we can work together. And that's the way it should be. Please get organized. If you're not organized, start now. That's great advice.
Thank you, Melissa. I really appreciate your insight and value. Melissa's been a dedicated moderator to our podcast a couple of years now, right?
Yes, I took a round fork in a road for about a year, and I've come back, and it's been nothing but valuable since, Joe. You always give valuable insight.
I appreciate the kind words. I mean, we cut it back a little bit because it was getting a little daunting for Yardell and I doing it every Sunday. So we cut it back to the first and third. I feel like I'm a little more re-energized. And then we're also doing a couple one-on-one interviews every month. So I really appreciate that because to be honest with you, I was getting burnt out from a lot of this, because even though it's great content, great education, you almost start thinking you're saying the same thing over and over again. So it's like, I just, yeah.
We appreciate everything that you bring to us, but you do have to step back, and I'm learning that myself. We can't just always work. You gotta reset. Find your reset and do it.
Yeah, I agree with you, and I appreciate that. Well, we're going to get on to the infamous and famous Mr. Bob Chesick. Good morning and welcome. Brief overview, who you are, what you do, and an introduction live with Valia Fisher. You're used to only emailing one another, so brief overview on who you are, what you do, and thoughts to the secret sauce behind asset-based lending underwriting, and any questions you might have for Valia. I consider Bob as part of my team of experts, which is a necessary component to good underwriting for to provide the right information, the righteous information to Valia to make sure she has the right information to present. I mean, she's presenting to somebody else with the entrustment that we have all the correct information. So Bob is a very valuable piece to that pie because 4 items out of the 12 items that we need in the checklist are the LLC documents. And Valia, I don't know if you want to add anything to how basic the checklist is, but how complicated it gets because people want to make it difficult because they know we're not collecting tax returns, pay stubs, W-2s, and 1099s.
Right. So there's a difference between a conventional no income, no asset type of loan versus a business purpose lending asset based loan. So it's not that we don't collect documents and we're not verifying the what is presented to us on an application. It's just that they're different documents. Um, I can just skip to the entity documents just one last time here. That another trend that we see is an entity is formed. Maybe it's a sole, so there's only one member. Maybe down the line they realized that they needed to add a member for liquidity purposes or to document experience. Well, I can tell you that the underwriters are onto it, and they're, so just adding somebody to a piece of paper, such as the operating agreement, is not enough. You can't just manipulate who belongs to that entity just so that you can bring in, maybe they've got a higher credit score, maybe they've got more liquidity, maybe they have more experience. Reporting is now asking for the articles for the formation documents to see if that person that is those people who were on there initially, or if they were formally added at some point in time. So that's just something to keep in mind as well, because maybe just even a few months ago, that process would have flown under the radar, but now it doesn't.
Excellent. Sure. We go. Good morning. Welcome. Thank you for your patience. Brief overview who you are, what you do, and questions or concerns regarding the subject today with Valia Fisher, the secret sauce behind asset-based lending underwriting.
Yeah, good morning, Joe. Good morning. First,
Yeah, it is.
Account that I just paid off, and I have a letter that they're removing it from the credit report. That has to end up being a hard inquiry if we're going to assist them with getting that updated on their credit reports right away, or time will heal that wound, and we can just wait the 30 days before so that it's updated. in the traditional way where the creditor sends in the data and then 30 days later it's updated on the report. Just depends on the timing needed. But I couldn't say it better myself. The utilization and the on-time payments are the two things that are that's going to be the largest factors in what your score is generated. And the models that we use, to answer your question on that, Dave, there's I think the Vantage, this is going to be like witchcraft to everybody else. It's, these, the names of the models are like, Vantage 6, Vantage 8, Vantage 4, and, so it doesn't really mean a lot. And honestly, in my past life, I worked for Experian, and how they generate a credit score, it really is like witchcraft because there's so many different factors that go into it. But if you do pay your bills on time and you keep your credit card utilization under 35%, I think is the magic number, you're going to most likely be in very good shape.
Thank you, Dave. And Valia, I have a couple interesting questions here that come to mind. Not many, because we try to keep this podcast to an hour. So yeah, because eyes start glazing on a lot of people if they stay too long here. So, including mine. If you had a crystal ball in the perfect world, as we know, we're currently financing 1 to 4 residential. 5+ units, typically up to 9, with an exception on 10-unit multifamily residential. We do fixed to rent, fixed to flip, and or new ground up construction and DSCR. But if you had a crystal ball, I wouldn't say more of a wish list. What do you foresee the non-QM space bringing in or accepting going into next year? Like, do you have a feeling like, will rural properties be something they add or allow, or modular home builds, or mixed use, or mobile homes with a VIN number, God forbid. But I'm just saying, like, is there something out there that you feel that if you had a crystal ball, or I don't really don't want to say wish list, you think they might go toward a little bit to add to what we do in our lane?
Use would probably be the number one area where they will expand their underwriting criteria. I don't think that rural is going to be something that they want to look at just yet, because it doesn't really make a lot of sense in our space for, if you're out there kind of in an agricultural area or rural land, are you really, not very many rentals are out in that area. That's what they're looking at, unless you're doing it's in a popular tourist area where you're doing an Airbnb kind of thing. But I would say mixed use would be the number one thing, just because it makes more sense to be in an urban area. You're going to have a store on the bottom. You're going to have living space on the top, and that's spreading throughout the country. Even in my area, I'm out on the West Coast in Long Beach, California, and that is the direction that all new housing is being built that way. You're going to have office and retail space on the bottom, and you're going to have living quarters on the top, depending on how many stories they go. But that's generally the new trend.
And what is the best advice you can give to someone, whether they have they're okay? We'll start with the easy question. What's the best advice you give somebody that's trying to buy their first investment property? From your perspective, like what are the best items that they should be keeping in mind? And then I have another follow-up question to that.
I would say that the best advice is to have some money in the bank. You're gonna need your down payment. You're gonna need your closing costs for purchasing. And additionally, we want to make sure we're not taking your last dime. So you're going to need 3 to 6 months, and that's depending on your credit. Liquidity after we close. So we make sure that you can, if you miss a couple of months rent after you get the project done, then you have the reserves to make the payments if you don't have income coming in yet. So that's one of the biggest things that we find as a challenge.
And then the next question would be, from an experience level, what is the best advice you would give that individual that's had 7 to 10 properties, and how could they scale leveraging asset-based lending and direct private lending from the underwriting perspective? Like, what will make them the better, more competent, more confident, and more welcoming client for closings over the next 12 to 24 months?
We love it when you are organized. Entity documents, if it's the same entity that you're using for all of your projects, that's even better because you don't have to provide as much information. If you're keeping these properties and you're collecting rents, have an account that you collect all of your rents into. Or, if you want to have a different account for each property, that's fine too. But keep it consistent. Make sure that the income is documented and can be easily seen on a bank statement. And if you're doing a rehab, make sure you have thoughtfully created that rehab budget and have really done your research and maybe talk to a contractor, because that is another hiccup that will, delay the process, because we do have a third party look at that budget and make sure it makes sense for the project. So those are a couple of things that would make you a superb client.
Excellent advice. I couldn't put it any better at your time of the hour, because you're a couple hours behind me. So I'm glad you have probably a cup of coffee, a couple cups of coffee in you to be coherent for this. But this is great. I think this is what people need to hear from an investing perspective. Whether you're a real estate agent or real estate service provider or an investor, I think you need to feel comfortable with this type of discussion with whoever you decide to work with. We're not saying we're the make all to break all, but we'd like to think we are. We'd like to think we're providing something separately different to somebody. I think, Valia, you would agree that I come back with very polite emails nowadays to the most, I would say, rudest of comments at times. I think I'm getting better in my old age. I mean, there's no reason to get hostile because it doesn't accomplish anything, right?
Frustrations, at any given point during the process, and maybe that's just we're trying to educate the client to make sure that they understand why we're asking for certain things, or why the process is taking, X amount of days, when, the expectations are something that Joe and I try to. But there is no reason to get hostile. We want your transaction to be successful and close just as much as you do. We have no reason to want to close.
Valia, I want to thank you for sharing your expertise with us today. I know our audience gained tremendous insight into how underwriting really works and how investors can position themselves for success. And understanding the lender's perspective is one of the biggest competitive advantages an investor can have, and you've helped demystify that process for all of us today. So everyone listening, thank you for joining us for another episode of the Creative Bird Strategy podcast. And remember, we meet on the first and third Sunday of every month at 9 a.m. Be sure to visit us at creativebirdstrategies.com for upcoming events, past episodes, resources, networking opportunities. We just had a cigar event. We just had an underwriting white label course. We're scheduling another white label course for September. We have a wine tasting and cheese wellness event first Friday in October in Philadelphia. We have a cigar event coming up in Lehigh Valley in October. We actually have a cigar event coming up June 29th with Gardell and I here in Philadelphia. If anybody wants to come around, come in on the weekend and stay till Monday to have a cigar with all of us. There's going to be about 40 of us networking at Capelli Brothers in Midtown Village in Philadelphia. As we wrap up this discussion on the secret sauce behind asset-based lending underwriting, one thing should be clear. Getting deals approved isn't about luck. It's about understanding how lenders think. Valia shared that successful investors don't just find deals, they present them well. They understand their numbers, they communicate clearly, provide complete documentation, and build credibility with lending partners. And asset-based lending may focus heavily on the property, but preparation, transparency, and execution still matters. The biggest takeaway from today's conversation is underwriting isn't something investors should fear. It's something they should learn and embrace. The more you understand the underwriting process, the better you'll become at structuring deals, solving problems before they arise, and creating opportunities where others see obstacles. On behalf of myself, Valia, Bob, Melissa, Dave, Yordell, we really appreciate you taking the time and listening in to Valia's expertise, and everyone who joined us today. Thank you for being part of the Creative Birth Strategies community. Keep learning, keep networking, keep taking action. Remember, the investors who master financing often create opportunities that others never even see. So I want to thank Valia again for coming here this morning and providing some great insight to the secret sauce to underwriting.
You're welcome. My pleasure.
And I always finish off with a quote. First, I want to, like what Dave did, happy Father's Day to all the fathers listening in throughout the country, throughout really the world, because we're on LinkedIn Live, we're on Facebook Live, we're on YouTube Live, and then we're loaded to Spotify, and then we go viral. So I want to thank everybody. But my quote this morning: greatness requires sacrifice. It breaks complacency, excuses, and comfort zone. It demands confidence, leadership, discipline, and a relentless pursuit of excellence. Get rid of the distractions, get rid of the excuses, get rid of the noise. Focus on becoming great. Commit to excellence in everything you do. The results will follow. Everybody have a beautiful Sunday morning. Have a great week. We'll see you on the first Sunday, 9 a.m. in July for another great subject at the Creative Birth Strategies podcast and house here on Clubhouse. Everybody have a great day. I'll be ending the room in the next 30 seconds.